Welcome. Um, Nice to see everybody. Let's get rocking and rolling. Uh, okay, okay. I think I think we're ready to roll. Um, let's talk just a little bit about what I'm watching in the market in general. The S&P is looking pretty interesting. It's not a spot that instills a lot of bullish thoughts in my brain, but we'll see where it goes. Let's see how things play out. Let's see what we end up with here. But I think there's a few important things that everybody needs to be aware of in how the S&P is setting up right now. We have a big dispersion all over the place of stocks that are getting crushed and stocks that are hitting crazy highs. But what is the S&P? What is the index itself telling us? There's some important things, and I think it's worth keeping an eye on. And I will run through those things right now. Um, so let's dive right into it. I'm going to show my screen here, and let's just see what we've got going on here. Okay. Okay. So here's my screen. I think it's working. I've got a couple of things that I'm looking at here. This chart right here. Let's just look at this. This is using my good buddies Koyfin. I love Koyfin. What a great platform. Um, and let's see. I think that's probably the best way to look at this. This is a 10-year history. We can go back as far as we want, 20-year, 5-year, anything. But what this is SPY. Um, and I always like to watch when we see this kind of stuff happening, right? So if we look at, let's just say, the last 10 years, I think the stock market, I mean, I don't think, I know, and I think we all know this, the stock market has changed quite a bit in the last uh, 10 years, certainly in the last 5 years, and certainly in the last 20 years. There's more money in the system. There's easier technology. There is easier access to the markets. There are more retail investors getting involved. Hundreds and hundreds of billions of new retail investor money is going into the market, adding to volatility, adding to just overall volume and everything. So what does that all mean for how the market behaves? Well, probably we're going to get bigger swings. We're going to get bigger extremes hit and so on. But when I look at this chart right here and I say, okay, given the past 10 years of SPY, this is our S&P index. This is kind of my go-to. We can look at SPX as well, but it's going to show us the same thing. So as we look at the past 10 years of SPY, we see that we're 2 standard deviations above the mean in a 10-year window. How do we look in a 5-year window? Well, we're over 2 standard deviations above the mean of the past 5 years. Okay, let's look at the last 3 years. Volatility's been way higher the last 3 years. Well, we're 2 standard deviations above the mean. Now, the other two, the 5 and 10 years, were greater than 2 standard deviations above the mean. What is a standard deviation? It's a dispersion of the average, right? And we're seeing some major runs above these averages. And so, yes, the market tends to, not tends to, the market is bullish, right? And so it's more common to be 1 or 2 standard deviations above the mean on the upside, and it's less common to be over a standard deviation below the mean, in these bearish markets, right? Although it does happen and it's usually fairly quick. But it is common to see that we are, above the mean as much as we are, and so on. Now, if we look at a 1 year, again, more than 2 standard deviations above the mean. So what does that tell us? that's at least an interesting heads up of like, hey, we're up there a good bit, right? So we're just looking at that. Here's one thing that I have always found interesting. Here's SPY again on this is TradingView, another charting platform that I love. And what this is showing us is TradingView. Um, I like to look at certain different things here to kind of measure what is interesting and what's happening here. Now, just from this view that we're seeing right here, make sure that that's updating good. From this view, I'm looking at 2017 to the present, so 9 years, give or take. One thing that I like to look at is simply this is just something I always watch in the back of my head, and it is ridiculous how effective this is. And this is very, very important to look at when we are trying to kind of decide, how much bullishness there might be left in the market. I'm terrible at calling tops, and I'm terrible at calling bottoms. I don't even try to do that very good. I have strategies that are structured to work around those kinds of situations because predicting is super difficult. But one indicator that I like to use, one signal that I think is so helpful and so important is to just let's just simply look at this yellow line right here. This is a 200 exponential moving average. It's a 200 moving average. This is looking back past the last 200 periods on whatever time frame I'm on and giving me the average price of that. Now, this is a weekly chart, meaning we're looking at each one of these candles is representing 1 week. So, we're looking back past 200 weeks back, and we're getting an average price from all of this. But it's pretty interesting if you start to just, here's my little percent tool right here. And if I say, okay, 2018, let's just start looking at some of these peaks. This is 2018, and about a 32% move above the 200 average price. This is 2018 right here, where the Fed started hiking rates and everybody panicked in kind of September, October 2018, and we saw that 20% sell off in the S&P. So before that, we had about a 25% move above that 200 period average price. This is obviously, March 2020. And what did we see? We saw about a 28% move before a real aggressive sell-off. Okay. And let's just kind of go down the list here. Here we had some big runs. Let's look at kind of some of the biggest movements here. 39%. Let's look over here. What do we have? 28%. Just trying to find some of the, just visually looking at some of the peaks here of how the S&P behaves with the 200 period average price. I'm just looking at some of these peaks. I'm just throwing them on here. Here is, March 2024. Nice little run there. And you guys probably can see where I'm going with all of this. Nice little run here. This is April 2025, ahead of liquidation day. What do we have there? And let's just go back and look at some of these and just, again, I don't hang my hat on this, but it's something I do like to pay attention to. And I do tend to watch in long periods of time. So we just have a couple of reference points here. These are just kind of visually what we can see since about 2017-18, some of the furthest moves from this 200 period average price, right? So we're looking for, let's see if we can find something interesting here. 2018, we went about 31% before we saw a decent correction. This was prior to 2018 sell-off for interest rates. That was about 25%. This is, February, March 2020. We went about 28% above that price. Here is, August 2020 when we went into some of the biggest rallies of 2020, 2021. About 28%, had a healthy little sell off, and then we took off and ran. Again, here is, the peak of everything, right? This was the peak of software, peak of all the stuff um, um, in the S&P. So we see this is January 2022 before the market sold off from the Fed rate hike of 2022 that just destroyed the market. And that was the biggest variance from the 200 period average price that we saw. It was about, let's call it 38% above that 200 period average price. Okay, great. Big sell off, aggressive. We started to recover, of course, towards the end of 2022, beginning of 2023. We got about a 20% run up before that final bottom of October 2023. Everything takes off and runs. Again, we get up about 28, 29%. Maybe we can even make that a little more, about 29%. That was kind of March of 2024, great year. We see this July 2024, we got about 32% above. Here is prior to April, that April, tariff sell off, April 2025 dip, big dip there. We got about 31% above, and then it takes off and runs. And then before we get, war and oil price spikes, we got about 31%. So what we can see here is there's one outlier, which was end of 2021, beginning of 2022, the biggest high before everything just came crashing down. That was about 37% above this 200 period average price. Everything else tops out in the low 30s, about 30, 32%, 31%, 31%. So it's low 30 percentile range where where the S&P moves above this 200 period average price on a long time frame before it starts to sell off and correct. Okay. Now I get that my yellow line here is a line in the sand. It's, it's getting washed away and we're having to redraw it and so on. And as the market continues to rise, this price or our average price continues to rise. I get that. This is why I watch it and I redraw it and so on. But it's something that I watch closely and something that I say, okay, whenever I see, even though, we've got a nice sloping uptrend here for this 200 period average price, great. But what do I see right here? I see that, currently, where are we? About 33% above the 200 period average price. We're about 33% above it right now. Now, what have we seen? We've seen a ridiculously aggressive, bullish couple of, several weeks in the S&P, right? We saw that bottom in March, basically March 30th, 31st, and then it's just been straight up since, right? So big bullish run. And I'm not trying to be the perma bear that so many out there are. I'm just trying to say, here's what I watch, and here's what is starting to make me a little bit cautious about what I am seeing. And we're at a spot where the S&P is, I definitely couldn't put any kind of bullish trade on the S&P right now. Could go higher, but when I look at how it behaves in these kinds of areas, it makes me a little bit concerned. Not to mention the seasonality of things. Now, the S&P could continue pushing through the end of May, and it likely will. We'll likely see some bigger, higher points here. But as we go into June and liquidity drops and volume drops and things tend to kind of settle in a little bit for the summer, hey, I know the old saying, sell in May and go away. And it hasn't really felt very, convincing the last several years. It feels like May and June and July have been pretty good months. We've seen some pretty big movements during those times. But when I look at this, I just think we have kind of a convergence of seasonality of kind of going into summer. We have some pretty high numbers on how far above the average price this is on longer terms. We're 2+ standard deviations on pretty much every 1, 3, 5, 10, 20 year movements on the S&P above the mean. We're just getting to a place where I'm not calling for a crash. I'm not saying the market's going to come down crazy, but it certainly is very much into overextended territory. Right now, when we take this into account, we see, okay, S&P is up a whole bunch. Yes, we have an AI revolution that has a ton of momentum to it. It has a ton of potential. There's also a lot of fear around it about how expensive everything is and whether or not it's going to pay out in the way that everybody is hoping with the amount of money they're investing. So there's some uncertainty out there for sure. But when you go and you see stocks that look like this, let's just go to a shorter time frame and we look at a stock like Intel and we say, how much is Intel up? Now, Intel's done some great things. Intel has been the dog of the stock market for so long. Look at this long-term time frame. We got to go back. This is 2000. This is the dot-com highs right here, and Intel's high was $75, and it only exceeded its 2000 high 26 years later. 26 years later. The government gets involved and then everyone jumps on Apple and Nvidia and all this stuff, which is great. Intel's making this fantastic run. But what could we potentially call a run like this? From the end of March till current, it's up a little over 200%. From low to high, it's up almost 230%. I look at this and I say, this is the melt up of melt ups. This is blowing tops off big time. This is major blowing tops off. Now we could say that's a lot of time to consolidate. Sure. Okay. I can buy that. This is our, it spent a good, year and a half down here. Fine. That's great. But this is aggressive. This is a little bit aggressive. Now we're getting a lot of AI traction. I get that, but there's enough stocks out there that are absolutely destroying it. One of my favorite stocks, by the way, and I have traded this like crazy, RKLB. It's our aerospace stock. This is our space stock. I've been in and out of this stock a bunch and I've made some great money on it. Big, nice run here. Now, certainly there's, a lot of good reasons for us to be doing what it's doing, but, in the last 3 days to be up 50%, that's pretty crazy. That's pretty wild. And we're seeing a lot of this. We're seeing a lot of this. And so, these kinds of moves seem to be happening in a lot of spaces. And when you pair that next to the S&P and when you pair that with the VIX, and the VIX being kind of at its at some of these levels right here, it's concerning a little bit, right? The VIX has stayed somewhat elevated. This is the long-term average price, 28. That's long term for the VIX. We get these big spikes above and we spend some time consolidating below, but these are some of the big, aggressive, wild spikes that happen on the VIX. But on average, the VIX loves to spend time in the mid to low teens, and it hasn't gotten back to the low teens yet. It's only gotten, on its biggest dip here in the last little while, we've gotten back to the, to the slightly upper mid. But we haven't seen those real low levels on the VIX. And that, that makes me kind of wonder. Nobody's really completely on board with this wild rally that we've been seeing happen. Again, I'm not complaining. April was one of the best months I've ever had, ever. So great. But I've been staying quite bullish on all this, but I'm becoming very cautious with what I'm seeing on the VIX, with what I'm seeing in the S&P, with what I'm seeing in individual stocks. And we're seeing a big divergence between certain types of companies and others, and who's benefiting from what. We're pretty divided. We're pretty divided here. There's always bullish stocks to trade in any kind of market condition, whether they're defensive or whatever they might be. But I'm just saying, I see the S&P going to a place that is becoming concerning. It's becoming very, very overextended, and I think that's worth paying attention to. And I think it's worth positioning yourself in a way that you can still take advantage of bullish markets, but that you're more defensively positioned for corrections. Don't get caught blindsided. We haven't gone completely plaid, as they say in my favorite, Spaceballs, but we're in a spot. We're in a spot, and it's not a spot to be ignored. Seasonality overlaps along with so much else. Um, I'd be cautious. I'd be pretty cautious here, and I am being cautious. And I'm saying, wouldn't be the worst thing for all of you guys to be a little extra cautious as well. So that's my take on the S&P. These are all levels and areas I've watched for a long, long, long time, for my whole trading career actually, and hasn't led me astray too much. So take it for what it's worth. Good luck. Happy trading, folks. Have an amazing day and week, and we'll go live again maybe towards the middle of the week or end of the week. I'll keep you guys posted. Just watch my profile for the details, and we'll take it from there. Thanks, everybody. Have a wonderful week, and take care.